Hi everyone, this is Michael Bengiat, and this is the Market Trend Advisory Weekend Report for April 30th, 2022. Before we start, this is our disclaimer. Please pause the video and read this. It's basically saying that all the content and information in this presentation is provided for educational, informational purposes only and should be knowing and considered investment advice. So let's go ahead and get right into the market trend. If you've been following our system for a while, you're long gone out of this market, and these recent really ugly days we're getting now shouldn't be affecting you at all. We had no exposure to the market now. We're in a correction. We have no positions either in the indexes or individual stocks or in non-index ETFs. We don't have any, we're not counting the institutional selling days anymore. Once we go into a correction, we stop counting them, so you'll see just a little line there. But even since we've been in the correction, we've been getting a lot more sell signals. We've had some of them like the failed rally attempt. We've broken to a lower low on our charts. We're now trending below the 21-day moving average. A week ago, we actually hit a circuit breaker, which means that that basically kicks you out if you hadn't been out already. We've had some bad breaks, which means you're closing down at least 2.5%, and you're closing at the lows on the indexes. We've had a lot of distribution and distribution clusters. So the big players are exiting this market now pretty much en masse, whereas we didn't see that for quite a long time. And same thing for the S&P. It's still acting a little bit stronger, but they're both pretty much in trouble. So we're going to come do some charts in just a second. For our investing strategies, the QQQ has entered a bear market now, down 21.26%. We're still down on our strategies, partly because of the way that the market started off this year with a massive rally, which turned out to be another just fake out, and gave us some returns into the negative column. But we've been out for a while, and for leveraged strategies, it's actually pretty good results, though we're not, of course, happy with that. But that's how it goes, and they'll quickly go positive once the market gets its footing, whenever that is. And for the SPY, S&P's has had a pretty bad day on Friday, yesterday. And so we're kind of closing in on our market count 2x strategy. So, well, but as of now, we're not in any of these strategies, so we'll just continue to watch. So here's the Nasdaq, a daily chart, and you can see here with this red line, we broke below recent lows. So all this really big bear market rally stuff, especially this one, we had 4 days in a row of huge thrust. There's actually a thrust indicator that gave us some pretty powerful buy signals here, but it just flamed out. I mean, it sort of didn't even get quite up to the 200-day moving average, which is this black line. And we got close, and it didn't even get there, and then it just flamed out, and we broke below two new lows. So kind of an ominous sign of what's going on here. It's starting to look more like the 2000 top, where we had a lot of back and forth, a lot of volatility, especially here, and then we broke down, and we started sort of the third leg down, which is usually the longest and the most powerfully, in one direction. So if you kind of look at this as this could be a one leg down, we had a little rally, counter rally, and then we start the next one down. Now, of course, we don't know if this is going to happen, but it's looking more and more like that. Plus, we've seen so much weakness in the Nasdaq for such a long time that it's a possibility that we're going to have to consider. The other side of it is that the Nasdaq's already been pretty much decimated with its tech stocks and growth stocks, so it could be we're nearing a low. Again, we don't know, but we'll have to kind of consider both sides of the equation. And we'll talk about a little bit more about that when we get to the sentiment indicators. So we're in a bear market too. Before we go to the S&P, we're down almost 24% from the November high. In 6 months, that's a pretty big decline, and it's just not looking very good for the Nasdaq. So for the S&P, we closed to the lowest level since May 2021. You can see here, that's back over here in the chart. That's with the red line. And we're only off 14.3%. which is pretty good. It's just that we've had a lot more of the cyclical stocks in this index that have been holding it up, including some of the industrials and companies like that. So let's move on to back to the Nasdaq. Now this is a chart we've shown quite a bit, and it's sort of an ominous chart if you look at what's happened historically. If we just go real briefly, I know some of you have already seen this a bunch of times, but if we go back to the late 90s, and we had this trend channel that we've added here. Now here we don't show the beginning of it in this chart, but it kind of went up here, and then we sort of just started being inside of the channel, and then we broke out above it. These channels go back, many, many years. And in fact, you can even see here the price would get up to the lower part of the channel, and it would hit resistance. And then finally we burst above it, hit the top of it, and then we broke out in a final parabolic run, and then the Nasdaq collapsed 85%. Now here we're going back from after the financial crisis. We've added a new channel, and again, it was being contained within the channel for many, many years, since 2009. Here we are, 2020. So in 11 years, we finally broke above this, which was corresponding, of course, with the coronavirus crash and the trillions of dollars that they added to the market to avoid an economic meltdown. But we broke above this, and these break when you get above it or even below it for a long time. They tend to be sort of like self-fulfilling prophecies. We had about a year here. We had a little bit less time over here, but when we finally broke below it, the markets tend to go much lower, and now we're definitively broken below the top part of this trend line channel. And we have here this, you can see the green line here, that's the 40-month, which if you look back here, it's held much of the declines over the last 10, 12 years. We did break briefly here, which was during the coronavirus crash, but we closed above it, we came back down and touched it, and then we took off. So we're still about 1,150 points lower to hit that point, which could be one of our targets for the downside. We've already, last week we showed the same chart, and it was 1,600 points lower. So you can see we dropped 450 points in the Nasdaq over the course of the week. So this is sort of an initial target that probably will try to get some support over there. If we don't get support there and it just crashes through that, then we've got a bigger problem in the U.S. than anyone thinks. But we'll come to that if that happens. What I want to do here is just show you some of the mega cap stocks and the earnings reactions that we've seen. They've all basically reported recently. Amazon reported on Friday, went down 14%, and for a company of that size, that's a pretty big miss. Netflix really just crashed. It's off 72% from its highs, and Amazon's off 34%. Microsoft reported and didn't really do anything. We'll call it flat. It's still in bear market territory. Alphabet went down a little bit. It's in bear market. Apple's the only one that's really holding up and it sort of opened up on Friday after its earnings strong. I think it went up 3 or 4% and it ended up down 3 or 4%. And it's the only one that's not in a bear market. Facebook had a huge reaction, went up 16% on supposedly better than expected earnings, but seemed like it was a little bit fluke, but it's also probably a lot of short covering there. We're still off 48%. So overall, these big stocks are not doing well in this environment. When the coronavirus crash happened and then all the money was flooded into the system, these companies were the biggest recipients. This because they're such big companies, they were able to take advantage of basically everything that happened on there. They were able to really have their employees, give them more freedom to work at home, and it really just juiced up their earnings and sales as people stayed home, and business sort of had to transform itself overnight. The fact that they're not doing well overall and they're reporting negative earnings, or at least their expectations of going forward, they're starting to give a lot more notice of, the supply chains are being affected. The inflation's really hitting their earnings and sales. So that's not a good sign going forward, because if these big companies are having troubles, then the smaller ones who don't have those resources or big cash piles sitting there, it doesn't bode well, and looks like the Fed is probably a little bit behind the curve here. And one final thing too, Amazon, it lost more than $200 billion in market cap on Friday. It's worst day since 2006. So this is a real big problem for the market. A lot of people would say, oh, these companies can never go down. You'll never see Amazon, go down 50%. Well, it's already off 34%, and these are the cream of the crop companies. I expect as this earnings, that this correction continues, unless it ends here, that we will see all of these stocks down at least 50%. That's just how markets work. Nothing just goes up forever, including Apple. And in its history, it's had many corrections of 50 or more percent. So, all stocks are risky. That's really the lesson here. And there really aren't any that you can just say, oh, I'll just buy and hold it forever. Well, in 2000, everyone thought Cisco and these other companies were, buy and hold forever. And Cisco went down, I think, 80-something percent too. If you go back in history to the Nifty 50, you get Kodak and many of the stocks back then, and they just collapsed. They were considered you buy and hold them forever. So that's where we are on that. I wanted to show a couple charts. We've had this ongoing bubble article that you can find on our blog, and that's just lifetimeinvestor.com/blog. You'll see it there. We sort of took it off of our big master database because I think the bubble has basically burst at this point, and now we're in the aftermath. I just want to show just this one chart, which is showing just the extreme overvaluation that we saw coming out of that coronavirus crash. This is that big move here, and we really came up to the valuations. So basically, this is the Buffett indicator. Sorry, I should back up a little bit. It's basically just it's counting the ratio of total market value to GDP. And only once before in the last 70 years have we seen such an extreme valuation, and that was at the top in 2000 when we had the internet bubble. And we basically exceeded that not long, just a little bit a month or so ago, and we're still at 190% ratio of market value to GDP, 45% higher than the long-term trend. And again, these things tend to revert to the mean, which is the black line here, which means this market, if it does, there's no guarantee it is, but just to revert to historical trend line valuations will be substantially lower. And again, it could happen. Again, if all depends on the Fed and how they're going to respond to interest rates. And it does look like they're behind the curve, and so we may be getting faster rate hikes than expected, and that's what the market does not like. It can handle pretty well, short, small changes, but not when they sort of figure out the Fed's way behind the curve and really needs to jack it up now because before it gets out of control. Another thing I wanted to show here is nothing really to do with the market trend, but it's a good lesson. This is the ARK fund run by Cathie Wood. She was the big star of 2020 and 21. Huge returns, I think a couple 100% returns. Here you can see this is a monthly chart. I mean, she's a bottom fisher, and it's destroying anyone who's in this fund is just getting killed. The year to date is almost down 50%, and in 1 year down 60%, and in 3 years you've really made no money. So that's going back to 2019. So you can see this huge destruction. But one of the things that she is doing, she believes wholeheartedly in the theory of these companies that are transforming. They're I can't think of the word right now, but basically they're disruptors. Sorry, that's what I was looking for. And that they're just disrupting all these different categories. The problem with that is that, yes, they may be, but you get stocks like this, Teladoc, which, yes, you can argue that it's in its area, it's going to transform the way healthcare is delivered. But you can look at the chart. The chart's telling you something else. This was a $260 stock, and it's now a $33 stock. But going back to Cathie Wood, she believes in this so wholeheartedly as that she's just thrown out any semblance of risk control in her zeal to invest, and she's investing with other people's money, so she doesn't really care. In some point, I mean, she can't really be fired because it's her own ARC funds. So what happened is that not only has she been buying all these stocks like this all the way down, she even bought right before this earnings announcement, which came out on I think it was Thursday, and it went down 42% on a total miss. But she was buying even more shares right before the earnings report, the day before. So it's mind-boggling that somebody with that much money under management is doing this kind of thing. Now, of course, she's coming out and saying, well, you have to have a multi-year timeline, but you can't sit there with your money losing 50%. There's no reason to have lost all this money. So the lesson in here is, you have to be very careful when either you're managing your own money or someone's managing it, that they are just have some very strong risk control built into whatever system they're using. Our market trend advisory system is really based all on risk control. We have we actually have more sell signals than we have buy signals. And the whole idea is that when the market gets bad, you're getting more signals that can tell you to lighten up and eventually be out. So this is just somebody who would be doing this. You really should not have any money with someone like this, because if this bear market continues, her fund will go basically to zero. I mean, there's no bottom to it, and wiping out any gains from anyone's made since this thing started. And we're pretty close there. I mean, this was 160 down to 47. You can already see in a bubble when you get these parabolic runs here. Look at these month after month of up, and then we've just wiped it all out, and we're back where we started. So that's the lesson there. Always look at investments as what's the downside. That's how the best traders look at it. They don't think, well, I'm going to buy the stock here, and I'm just thinking, where am I going to sell it? When is it, 100% or 200%? No, they're always thinking, what is the downside? If I buy it here, how much can I lose? And where should I be getting out in relation to the risk? And like for what we've seen lately with all this volatility, another reason to be out is that there's just way too much volatility. And even if you bought something correctly, you'll probably be kicked out on just the shakeouts that happen. And you just, what a lot of traders always think of, 8% loss is the most they'll ever take on anything. And then you're just out. And just that alone would keep you out of these kind of debacles that we're seeing with this fund here. Okay, well, let's go back to the market trend. So here's our chart of the technicals. What we're seeing here is that we're seeing less and less stocks are above their percentage of stocks are above the 200-day moving average. We had that big thrust up. I'll go back to the chart. Back in the Nasdaq, we jumped back up into the upper 30s and almost at 40, and then of course we're coming back down. We're seeing the 52-week lows just swamping the 52-week highs. Now we're starting to get to levels here that we may be starting to see some kind of a bottom or a washout low. They sometimes call these 90% down days, especially in volume, when the volume's just outpacing. And we do see that over here. On Friday, we had 861 stocks down on volume and only 79 up. So that's giving us pretty much close to that. We had another day here on the 26th, and we had another one here on the 22nd, and so we're getting close. I also want to look at sentiment here, which is not confirming. And one of the things that when we saw that huge rally that happened in the Nasdaq, the sentiment dropped down to panic. We're still basically in fear, even though we dropped a lot. And you can even see here, just until recently, we were kind of in the lighter reds, even in the sort of the grayish green level. So we were kind of neutral. We're starting to drop down again. And the put-call ratio, it spiked to 1.08, which is above ones when you're starting to get to the level where the buyers of puts are exceeding the calls. And when that gets too extreme, you start getting market bottoms. or at least short-term bottoms, I should say that. But when you add it all up, even with the weekly bears and bulls, the sentiment, we're roughly neutral to a little bit of fear. Now, the VIX also jumped up here, which has been a very difficult indicator to use. We've talked about this because it's been solid red for like a year, because normally the VIX will not be up in the 20s and 30s. It will be, down below 15. But since it's been solidly stuck there, you can see it got a little bit less red on the 4th of April. It's been a little misleading. And also the CNN fear greed indicator has other things in there besides stocks. It deals with some other sentiment indicators. It has some bonds in there. There's a lot of things that go into that, and it's been giving us some of those index. Some of the parts have been really down in the fear or panic level, but other ones are actually quite bullish. So this is the problem in a bubble. When you get these run-ups, let's go back to this chart. When you get to these dislocations in the market, when they just move out of the standard area of what they're used to, even over here, and when they go into these final runs, it's usually something's going on. This was just a mania that was going on, and stocks were just being valued at eyeballs. How many eyeballs are coming to the website? Here we had just had an extreme amount of money that was pumped into the system that dislocated the whole thing. So when you get these kind of dislocations, it becomes very difficult to sort of track how things are working with some of these traditional metrics. But overall, the market's telling us it's not liking what's going on. So in terms of sentiment, just to wrap it up, we're not seeing the just absolute panic and fear that marked the last bottom when we had that huge thrust off there. But we're still kind of floating around here. So we'll watch this, because this has been a pretty good indicator on the downside. Now, one of the things that we have to be also aware of is that when a market gets down into this fear level and can't rally, that has been a good portend of an actual market crash. Now, we could go into that mode. It's probably not likely, but all depends, probably what's going to happen on Wednesday. So let's go to our final notes here. So in the very bottom here, the Fed's going to have their meeting on Wednesday, and they're widely expected to raise the rates by 50 basis points. And there's also, there's a good chance they may have another 50 basis point hike coming up in June. And the market doesn't like these bigger jumps. In fact, some of the Fed governors were actually looking to do a 75 basis point. Now, the market didn't like that at all. The faster they're raising means the more behind the curve they are, and the more the market's going to sell off. So that's really, Wednesday is going to be a big day in terms of the direction of the market in the short term. We could get just a massive run up. Well, you've seen if the Fed kind of comes out with some soothing words that, well, we're going to take it easy, which, they're, to be a little cynical, they're lackeys of Wall Street. I mean, the Fed has just been doing what Wall Street wants for years, and unfortunately has caused a lot of problems when you're manipulating interest rates to please one section of the public or the private sector. So we'll see what happens there. Just a couple other things. That's the most important thing to watch out for. Again, we already know that it's all about interest rates. We had a dismal month as all these headwinds are hitting the market. One thing that also came out on Thursday is that the U.S. economy contracted for the first time since the second quarter of 2020. So the market, again, it's like another thing that's been thrown at it, doesn't want to see any signs of recession coming up. And again, the faster that the Fed has to raise interest rates, the more of likely that it's going to engender a recession, which is sometimes it has to do. Back in the 80s, Paul Volcker was the Fed chief, and he had to jack up rates substantially to break the inflation thing. And interest rates were up in the 16, 17%. People had to get mortgages back then. They they had to pay 14% or more for a mortgage, where people today were getting them at 2% or so. So it's a whole different world. So basically, just as of now, risk-off sentiment prevails. We're also And we're seeing this also hitting other markets too, not just the stock market. And it's becoming more of an issue that many companies now in this earnings season are just pointing to, elevated costs, elevated issues with their ongoing operations, and of course ongoing supply chain disruptions. We're also in a seasonal sell in May, go away in May and come back, which is actually, for whatever reason, does have some validity, especially in the second year of a presidential cycle. So at this point in the market, we got a lot of things that are really pushing the market down, not a lot of positives. I guess really going to just wrap it up, as I said earlier, it's all going to depend on how the Fed's going to position itself. Is it going to sort of kowtow to Wall Street and try to give it what it wants to hear, or is it going to have to just give it the hard medicine to push the market more towards the economy more towards recession? And in part, it may not have no choice to do that because it has to withdraw all that liquidity that it dumped in. I mean, it was just trillions of dollars that made its way in. And unfortunately, it's made its way into the stock market because the market's being considered basically the only place to put money. Bonds, you're losing. And I've got there's an expression that people have been using, kind of like YOLO. You only live once. There's another one that they use for the market. It's like the only place you can go. And that's not a healthy thing when all these things are just riding on how well stocks are doing, because the stock market is not really the real economy. It's just a part of the economy. So, and just one final thing I have over here, that Warren Buffett, his annual meeting of Berkshire Hathaway, it starts today. It's like a rock concert because they get over 40,000 people that attend it. And so that's something you might want to just, you'll see it in the news. He always gives off a lot of great gems of wisdom. And it's for any kind of investor, you can learn a lot just by listening to what he says. So that might be something you want to check into. Okay, we'll wrap this one up. And we'll be back next week. Will probably be an interesting week with probably a big move one way or the other in the market. Okay, we'll talk to you then. Thanks.